All right, CVS Caremark, a behemoth, a leader in drugstore industry services, also pharmacy services, embarking on an aggressive expansion strategy at the same time, maybe feeling some pressure from Walmart, it says here. Let's get a view from the top with Thomas Ryan, Chairman and CEO, CVS Caremark, joining us now, former winner of the entire thing at AT&T at Pebble Beach. What year was that? Your name is on the stone, Ryan, right?
It is, yeah, 2003. I had the right partner, Joe.
Well, and the right handicap, I hear. No, that's not true.
I didn't say that, Tom.
We're not going to get into handicap.
No. I'm kidding.
Right.
He's giving me grief about.
Let's get into the business.
We're good. We're moving along here. A lot to talk about, Tom. A huge company after the acquisition of Caremark that you're trying to drive around here. Why is a $2 billion acquisition a long drug? Does that make sense?
Well, it makes sense for the overall enterprise, Joe. It's, as you know, their stores are out in California and Hawaii, and those are markets where we don't have any penetration for our stores. So there are markets that are difficult to get into, and we saw an opportunity to get those stores in those markets. Plus, we believe we can improve the performance of the Long's stores.
Yeah.
We have a track record of doing that in the past. We did it with Eckerd. We did it with Save-On. And then it expands our footprint for our PBM business. We have clients all over the country. So to get stores in Northern Central California and Hawaii helps our overall PBM business.
Yeah, I remember when all those PBMs, when the big pharmas had to have them. The PBM that you had was that was 3 PBMs at one point, wasn't it?
Exactly. It was the Caremark and PCS and Advance, and it was combined over the years.
Did you ever go back and look at the peak market cap of those 3 when they were trading at one point and what you paid for them? I imagine you got a deal because they went in favor, they fell out of favor.
Yeah, we think we got a fair price with the merger of equals, with the deal. And at the end of the day, we always say we don't do acquisitions for growth. We do acquisitions that we can grow. Mm-hmm. And if you look at our total enterprise, we're going to grow this enterprise. We have earnings growing at 16 to 17 to 18% this year, wow, and revenue 17%. So we feel pretty strong about it, and it puts us into the broader healthcare market. Now 85% of our revenues are coming from pharmacy and pharmacy healthcare.
Back to Long's, Tommy. You got to feel pretty good about getting that footprint in California. That's very tough, very difficult in retail, and really gives you a chance to take your concept national.
David, you're absolutely right. I mean, we had a chance to do this. Obviously, in the public documents, you can see that it was another buyer there. They couldn't meet the price. They had FTC issues. We think we're paying a full and fair price for it for the Long shareholder standpoint, and we think it's very good for the CVS shareholders.
So yeah, what's the criticism with the hedge fund? I've read somewhere.
We're going to run a SOT here. Let's run the SOT, David. Earlier this week, we had hedge fund manager Bill Ackman of Pershing Square Capital. That's the second largest shareholder of Long's, and he commented on the CVS offer.
We think the values here. The real estate values alone, we think, are in the high $2.9 billion. Basically, the price they're paying, they're getting the retailer and the PBM for free. So, we think values here are, as high as $90, $95.
And he made the case, Tom. I don't know if you were watching. Did you see that interview or see a replay of it, Tom?
Yeah, I saw the replay. I didn't see it live.
Didn't see it live. He was more or less saying, you buy this thing. It's an odd structure that it's a year for the tender. You get paid the dividend, and you can wait. Because I guess his point was that Long's hadn't auctioned itself. It hadn't gotten the best deal. How do you respond to that?
Well, let me just back up and talk about the real estate for a minute. There's a lot of misconceptions out there on the real estate. Long's owns about 210 stores in their portfolio. And we've been in the sale-leaseback business for over 10 years. So we estimate that those are worth about $1 billion. But first of all, when you do a sale-leaseback, that doesn't reduce the purchase price, because now we have stores where we had to pay no rent, and now we have to start paying rent. So all it is a financing vehicle. And of those 200 stores, about 30% are on leased properties, which are much more difficult to finance out. So it's not so clear. And I think there was some mixed information in the marketplace.
Aren't you already paying a 50% premium, Tom?
It's a 50% premium, David, to where the longs has been trading over the year. In fact, when we first sent our letter in, it's a 70% premium to that. So it's about 10.5 times EBITDA, which is consistent with other deals in the marketplace. There's certainty of the deal. We have FTC approval. The deal's been out in the marketplace for 30 days, and there's no other bidders. There's nobody coming over the top. So from the standpoint of why long shareholders should wait, I think that's a mistake. You get the time value of money, you have the uncertainty in the market, you have the long's performance in California that could deteriorate. So from our standpoint, and we're not moving, we're done. So that's where we are as far as our price.
Carl, one of the things that, you see a lot of times when people make acquisitions, they make the acquisitions, they look good on paper, then you don't execute. I think one of the things that CVS Caremark has done when they've acquired, they have executed and driven tremendous shareholder value.
I was going to say, I remember when the day that was announced. Remember, Joe? I think it was on this show, in fact.
I think that, would you say, Tom, that the synergy between CVS and a PBM it never worked with, it seemed like, with the pharmaceutical companies. Is this work this way, this business model?
It really has worked for us. We had, obviously we have the purchasing synergies, and those help you make the bridge, but the real win is the other revenue synergies for any company. And, we had access to the consumer that came into the store, 4 to 5 million a day. We never had access to the payer, to the plan benefit design individual. So now we're having different discussions with the Fortune 500 employers, the managed care companies, and big pharma. So it's been a real win for us when you think of, we have the PBM, we have the retail, we have the specialty, we have Minute Clinic, and it's all around, getting better access, lower cost, and better quality for health care for our payers and then ultimately our consumer.
Tom, you're on the board of Bank of America, yes?
I am.
They're in the news these days.
They are.
We cannot let you go without asking for any clarity about what may happen with Lehman Brothers, or even your own personal view of whether or not that would be good for B of A, getting them into underwriting, getting them in to investment banking, getting a piece of Neuberger. Does this make sense?
Well, first of all, obviously I can't comment on that, Carl. So I can comment on longs, we can comment on our business, but I can't comment on anything for the bank.
Yeah.
All right.
Not surprising?
No, that makes sense. I want to ask you about the government plans, how we're going to fix this mess in health care. I wanted to show your stock, which was at $10. It's now at 40, when you got things like Rite Aid that can't get out of single digits. That's not the one. Give me a 5-year. Anyway, Tom, we appreciate your time, but you'll see a 5-year stock goes from 10 to 40 in a pretty tough business, facing Walmart, too. So you got to come back. Will you do that?
I will.
Excellent.
Good talking to you guys.
Great. There's the 5-year, and that's a drugstore chain.
I think it really isn't now, and that's what's interesting.
Right, it's not.
This guy has totally transformed that industry from going from a drugstore company to total health care services.
All right.